So lump sum investing versus dollar cost averaging is something that I get asked on basically every single phone call that I do with a potential investor. And what they're asking there is, say they have $100,000, should they invest the full $100,000 immediately, or should they break that up into, say, 10 parcels of $10,000 and get into the market gradually? It's an incredibly common question, especially when things are, say, volatile, or there's a lot of geopolitical tensions, or big macroeconomic events happening around the world. I can tell you, I don't know of a time when there's not been those things happening. So that's a topic for another day, though. So let's talk about lump sum investing versus dollar cost averaging. And there's kind of two correct answers to this. So firstly, there's the statistically correct answer. So what is going by the actual stats. And then there's the correct answer that kind of works best for you. So let's look at the stats first, and I'll get into both of these answers. So I'm now across here on the Vanguard website. Vanguard, we use the Vanguard ASX 300 ETF, VAS. And so let's have a look here. 68% of the time, this is on this particular study that they've done, lump sum investing outperforms dollar cost averaging. Now, it's important to note that dollar cost averaging on 69% of the time of this particular study outperformed cash. So that means outperforms just sitting in cash. And 70% of the time, lump sum investing outperformed just sitting in cash as well. So that means the stock market return was greater than your cash return, okay? And that makes sense. Now, why is this the case of lump sum investing outperforming dollar cost averaging? Well, the market goes up more often than it goes down. And so if you've got a larger sum of money invested sooner rather than later, then you've got more money earning you capital growth on your investments. That's the share price increasing. And also then income from dividends. And here in the Australian market, if I go across to my particular portfolio, you can see my dividends and interest there. In the Australian market, income does make up a very large percentage of your return. Now, there's a fantastic saying for those people who are looking at dollar cost averaging a lump sum. There's a fantastic saying by this guy here, Peter Lynch. He wrote one of the all-time great investing books. He is one of the all-time great fund managers as well. He's got a saying that more money has been lost waiting for market corrections than in market corrections themselves. And so that means opportunity cost. So if you're thinking, oh, geez, it's not a great time to be investing because there's so much uncertainty in the world, that is opportunity cost. If you're going to sit on the sidelines and wait, that's what we're referring to there. So you're forgoing dividends, you're forgoing capital growth for a future event that might not actually happen. Now, just a note as well, though, if you're looking to invest and then just gradually add your savings as you continue to save, fantastic. That is just an excellent example of dollar cost averaging. Now, the psychological correct answer is whatever actually works for you. So if you're a nervous Nelly, if you're sitting there going, you know what, oh, geez, I'd rather just break this up into 10 little parcels and gradually enter into the market because I just don't know what's going to happen, that is okay as long as you stick to your plan. What you don't want to be doing is actually stopping that dollar cost averaging into the market because you get nervous or because you think, geez, something is just around the corner. That's not how to do it, okay? So to sum up here, if you're looking to dollar cost average versus lump sum, 68% of the time, statistically, the lump sum outperforms that dollar cost averaging. But if it's a matter of you jumping into the market and just starting your investment, we prefer you do that and dollar cost average so you're comfortable. But as long as you stay invested, that's the most important thing here. Stay in the market. Volatility, the ups and downs, that's the price of admission, to quote another really good investor in Morgan Housel. So if you want to have a chat about this, I talk about this every single day. You'll see my Calendly link in the notes below. Cheers.